I hope this message finds you well, and that most importantly, you are remaining safe and healthy. As the members of our firm continue to work diligently to be the stewards of your assets, we all remain to be healthy at this time. I wanted to take a moment to discuss where we came from, where we are now, and what comes next. So, now what? Though far from certain, it appears that the worst of the COVID-19 may be behind us. And perhaps the worst of the stock market correction is behind us as well. The two are clearly closely related. Neither the virus nor the market will improve in a straight line. That being said, there may be some light at the end of the tunnel. So first, let's look at COVID-19. At this point, worldwide daily new cases peaked on April 3rd at around 96,000. In the US, daily new cases peaked on April 4th at around 34,000. Although social distancing measures have helped slow the number of new cases, the number of people testing positive still exceeds the number of people who are recovering on a daily basis. Therefore, the number of infected people, or what we call active cases, continues to increase. But we are getting closer to that famed flattening of the curve. Sadly, there will be many more deaths. But the worst case outcome of millions of deaths and a healthcare system that became completely overwhelmed appears to have been averted. Next, let's look at the stock market. We just endured the most rapid decline into a bear market, down 20% in 16 days, and down 30% in 22 days. From the S&P 500's closing high on February 19th, the index declined just shy of 34% by March 23rd. That is an astonishing drop in just over a month. Stocks were discounting a doomsday scenario. COVID-19 daily new cases had yet to peak, and no one knew exactly what was going to happen. The volatility index, or VIX, closed at an all-time high on March 16th at 82, one of only 3 times in history that the index had ever closed above 80. Now, less than a month later, since the March 23rd low for the S&P 500, the index has rallied almost 27% and could now be considered in a bull market. The VIX has settled down and closed below 40. Keep in mind that this is still a high level of volatility being priced into the market and is just above twice the long-term average. In fact, 35 of the last 41 trading days since the market high on February 19th, the S&P 500 has moved by more than 1%. This compares to annual averages of about 62 days. Now, we would expect this elevated volatility to continue for a while as the virus, economic, and earnings data are starting to be digested. Much like stocks, we could expect COVID-19 data to be an improving trend, although choppy. Economic data will deteriorate for a few months or more. Unemployment is a good example. The official unemployment rate is released once a month. The last release on April 3rd showed an increase to 4.4% for the month of March. This was a big increase from the 3.5% unemployment rate in February, which was near a 50-year low. The number of people filing for first-time unemployment benefits, which is known as the initial jobless claims, is released weekly. Over the last 4 weeks, 22 million people have filed for first-time unemployment benefits. This suggests that the new unemployment rate, which will be released on May the 8th, will be approaching 20%. That is a terrifying number. But remember, stocks are forward-looking asset classes. What that means is that news that is known is reflected in the stock prices. More COVID-19 cases and deaths are widely known, and in fact, that economic number will look awful for a few months. But stocks also will reflect what is expected to happen. In the middle of March, the range of possible outcomes was gigantic, As the severity of the virus was uncertain, thus the magnitude and duration of the economic shutdown was so uncertain. Today, the possible range of outcomes, although still wide, has shrunk, and a path to recovery, both from a health and an economic standpoint, can now be envisioned. So where does that put us? The short answer is that we are on a gradual road to recovery. We are hopeful that the worst of the virus and the stock news is behind us. We are not so naive to think that things will be back to normal overnight. But we do believe conditions are improving. As dramatic as the stock decline was, the 27% rally in 18 days is also eye-opening. Don't expect there to be improvements in either the pandemic or the stock market every single day. In fact, expect more turbulence on this flight and keep your seatbelts fastened. While we do expect a safe journey, investors should expect to be jolted around along the way. You have to stay calm and stick to the long-term plan. There are the times that highlight the value of solid financial plans, a well-diversified portfolio, and a rational long-term perspective. These are the times that determine the likelihood of a client achieving their financial goals. The surest way to miss the mark is to waver when things get choppy. We believe the surest way to achieve long-term goals is for investors to stick to their original plan that was developed at the beginning of the journey when they were calm, logical, and not emotional. So, we continue to monitor and make allocation changes where necessary. And at any time, please don't hesitate to reach out to us. So from our families to yours, thank you. Thank you for your continued partnership. We are privileged to do what we do every single day at Whalen Financial. Our country will persevere and come out of this pandemic stronger than ever. That I am sure of. It's been so nice to spend a few moments with you, and have a great day and stay healthy.